Hi, in this video we will solve example sums for treatment of reserves and accumulated profits and losses at the time of retirement of a partner. Both the methods of treatment will be discussed. First example sum: X, Y and Z are partners in a firm sharing profits and losses in the ratio of 3:2:1. Z retires from the firm on 1st April 2019. On the date of Z's retirement, the following balances existed in the books of the firm: General Reserve Rs 90,000, Profit and Loss Account debit balance Rs 15,000, Employees Provident Fund Rs 1,20,000. Workmen Compensation Reserve of Rs 12,000 was no longer required. We are asked to pass the journal entries for the adjustment of these items on Z's retirement. Let's go ahead with the solution. Solution: Journal, date, particulars, LF number, debit rupees, and credit rupees. They haven't specified which method to use, so we have to use the first method in the absence of information. Our approach to the problem will be to distribute the general reserve of Rs 90,000 and the free workman compensation reserve of Rs 12,000 among X, Y and Z in their OPSR, which is 3:2:1. Employees Provident Fund is not a reserve to be distributed. It is in fact a liability, so we will ignore it. The Profit and Loss Account has a debit balance, so it's an accumulated loss, and the accumulated loss needs to be written off among all the old partners in their OPSR. So the first journal entry, we will begin with distributing the general reserve and the workman compensation reserve Rs 12,000 no longer required. Date: 1st April 2019. General reserve account debit, $90,000 to be distributed. Workmen compensation reserve account debit, 12,000. Total 1,02,000. We'll distribute this among X, Y and Z in 3:2:1. So we have 2 X capital account, 2 Y capital account, 2 Z capital account. 51,000 against partner X, 34,000 against partner Y, and 17,000 against partner Z. Narration being reserves distributed. Second journal entry, same date. We'll write off the accumulated loss, the P&L account having a debit balance of Rs 15,000. We'll write it off among all the partners in OPSR. So the journal entry for this: X capital account debit Y capital account debit, Z capital account debit, to profit and loss account. Against profit and loss account 15,000 rupees. The 15,000 rupees has to be written off in 3:2:1. We have 7,500 against partner X, 5,000 rupees against partner Y, and 2,500 rupees against partner Z. Narration being accumulated loss written off. So these are the two journal entries. Answer for this example sum 1. The first entry was to distribute the reserves, and the second entry was to write off the P&L debit balance. Please note the Employees Provident Fund is a liability and not any reserve to be distributed. Example 2. X, Y and Z are partners in a firm sharing profits and losses in the ratio of 3:2:1. Z retired from the firm on 1st April 2019, and X and Y decided to share future profits and losses in the ratio of 2:1. On the date of Z's retirement, following balances existed in the books of the firm. General reserve rupees 1,80,000, profit and loss account debit balance rupees 30,000, workmen compensation reserve rupees 24,000 which is no longer required, and employees provident fund rupees 20,000. We are asked to pass a single adjustment entry for the above so that there is no change in their book values. That is, the above items continue to appear in the reconstituted balance sheet of the firm. So as per the question, we need to pass a single adjustment entry and to ensure that there is no change in the book values, that they continue to appear in the balance sheet of the reconstituted firm. So it's clear that we need to use the second method. Let's go about doing the sum. We'll begin with the working notes. The step 1 is to ascertain the net effect. We need to add the liability side items and deduct the asset side items. 1,80,000 general reserve. We'll deduct profit and loss account debit balance. Comes on the asset side of the balance sheet, accumulated loss, plus 24,000 workmen compensation reserve. Employees provident fund is a liability, it will not affect the solution. The answer to this is rupees 1,74,000. The step 2 is to ascertain gain or sacrifice of each partner. We have the OPSR between X, Y and Z equals to 3:2:1, and the NPSR between X and Y equals 2:1. For partner X, 3/6 minus 2/3. So negative 1/6 X gains. For partner Y, 2/6 minus 1/3, nil, no gain or sacrifice. And Z is a retiring partner, so he sacrifices 1/6. Let's go ahead with the solution. Journal, date, particulars, LF number, debit rupees and credit rupees. The answer for net effect, it's a positive figure. So we need to debit the gaining partner and credit the sacrificing partner or the retiring partner also. The date, 1st April 2019. Gaining partner X, X capital account debit to the retiring partner Z capital account. Amount of net effect, which is 1,74,000. In the case of X, multiplied by his gain, 1/6. And the case of Z, it's 1,74,000 multiplied by his sacrifice, which is 1/6. On dividing, we have 29,000 rupees. Narration being reserves and accumulated losses adjusted among partners' capital accounts. So this is the answer to example 2, where we followed the second method to solve the problem. First step is to find out the net effect. Second step is to find out the gain and sacrifice of each partner. Since it was a positive net effect, we debited the gaining partner and credited the retiring partner. In case it had been a negative net effect, we would have had to pass the reverse entry by debiting the sacrificing partner and retiring partner and crediting the gaining partner. Example 3. A, B and C are equal partners in a firm whose books are closed on 31st March every year. Give journal entry to distribute general reserve of rupees 40,000 at the time of retirement of B, when 25% of the balance of general reserve is to be transferred to investment fluctuation reserve. Let's go ahead with the solution. Journal, date, particulars, LF number, debit rupees, credit rupees. They've asked us to give the journal entry to distribute the general reserve of rupees 40,000 after transferring 25% to investment fluctuation reserve. So the distribution of general reserve comes under the first method. So let's pass the journal entry. General reserve account debit The total general reserve amount is rupees 40,000. To investment fluctuation reserve. Account. We need to transfer 25% of the general reserve. So it's 40,000 multiplied by 25 divided by 100, which is 1 by 4, or in other words, rupees 10,000 is to be transferred to investment fluctuation reserve. The balance is 30,000. We'll distribute it between A, B and C. To A capital account, to B capital account, to C capital account. The remainder general reserve, rupees 30,000. A, B and C are equal partners, so it's 1:1:1 their OPSR. So we get 10,000 against each of the partners. Being 25% of reserve transferred to IFR and balance distributed among all partners in old profit sharing ratio. So this is the answer to example 3.